blueprints behind the Secretive Syndicate. It started far from the public eye, in quiet rooms where powerful men spoke in measured tones. No crowds, no headlines, just a handful of decisions that would shape the future of American finance. And for years, few outside those walls understood how deeply those choices would reach. To see why this story still matters, we need to step back into an era defined by ambition and imbalance. Banks were multiplying across the country, each one operating with its own rules, its own risks, and its own vision of prosperity. The economy was expanding at a pace that left regulation in the dust. And woven through this rapid growth was a central unease, the sense that the system looked solid only because no one was digging too deeply into its foundation. Those foundations had their own truth. Privately, industrial leaders and influential financiers recognized that the patchwork of institutions had become dangerously unpredictable. In their view, the country needed a coordinated structure, something stronger than state-chartered banks, more stable than seasonal credit cycles, and far more capable of weathering national shocks. They believed the solution depended on collaboration, secrecy, and a plan bold enough to rewrite the rules of American finance. At first, the idea took shape as a simple proposal: unify resources, pool influence, create order where chaos had become routine. But as the conversations deepened, motives blurred. Some participants sought stability, others saw opportunity, and still others sensed a chance to craft a system that favored their own strategies and strengths. What began as a blueprint for reform slowly transformed into something more complex, more guarded. Early steps unfolded quietly. Meetings were scheduled discreetly. Correspondence avoided unnecessary detail. The individuals involved understood the stakes. If the public realized the syndicate of powerful figures was reshaping financial architecture, backlash could derail the entire project. So they worked in silence, building a plan meant to solve a national problem while protecting their own interests. Yet even in these early stages, cracks appeared. Not everyone agreed on how much influence a central coordinating body should have. Some wanted broad authority. Others insisted the syndicate remain behind the curtain, pulling levers without claiming official power. These disagreements created the first signs of tension, revealing that the quest for financial stability would collide with the equally powerful desire for control. Still, the blueprint advanced. Piece by piece, the syndicate laid the groundwork for a transformation that would soon extend far beyond their secret meetings. And though few Americans knew it, the nation was approaching a turning point, one that would define the next era of banking, trust, and national identity. As the syndicate's blueprint expanded, its members pushed deeper into negotiations that blended cooperation with quiet rivalry. Each participant carried a different vision of what the future should look like, and each feared that conceding too much power would render their own institutions vulnerable. The very leaders who sought unity now found themselves navigating a maze of ambition, secrecy, and competing priorities. Yet none of them could deny that the old system was cracking, and doing nothing was no longer an option. The group's early drafts focused on stabilizing currency flows and creating a buffer against seasonal financial shocks. But these proposals soon evolved into something far more ambitious, a coordinated network capable of guiding markets rather than merely reacting to them. The idea unsettled even those inside the room. Could any entity, formal or not, be trusted with such influence? And if they built it, who would truly control it? These questions lingered unspoken, a quiet current shaping every discussion. Outside their private circles, the country continued to face the consequences of an unpredictable system. Farmers struggled with wild swings in credit availability. Merchants worried that a single bank failure could collapse local economies. Industrial growth, impressive on the surface, depended on credit lines that could vanish without warning. These pressures fueled the syndicate's urgency. They believed they were crafting a safeguard, even if the cost was operating in shadows. But secrecy carried its own risks. As rumors seeped into public discourse, newspapers speculated about hidden alliances forming among the nation's wealthiest financiers. Citizens debated whether these whispers signaled hope or danger. Some saw the possibility of long overdue reform. Others feared a consolidation of power that would leave ordinary Americans voiceless in decisions affecting their livelihoods. The syndicate pressed forward, knowing that exposure could unravel their work before it matured. Inside the meetings, tensions hardened. Those favoring transparency argued that any solution lacking public trust was doomed to fail. Others insisted that unveiling the plan too soon would ignite political backlash and sabotage. This divide created uneasy pauses in conversation, the kind that revealed how fragile the alliance truly was. Yet despite disagreements, the group continued its task, shaping mechanisms, drafting protocols, and outlining a financial framework unlike anything the country had known. As the blueprint neared its next stage, one reality became undeniable. The syndicate had crossed a threshold. What began as an effort to patch weaknesses had transformed into a sweeping attempt to redesign the nation's financial machinery. And with each passing day, the weight of that transformation grew heavier, signaling that the conflict ahead would challenge not only the syndicate's unity, but the future of American banking itself. The turning point emerged when the syndicate's work collided with forces far beyond its secluded meeting rooms. As drafts circulated among a slightly wider circle of allies, political leaders caught wind of a coordinated effort to reshape the financial system. Some viewed the plan as a lifeline in an era of instability. Others saw it as an encroachment, a private power block attempting to steer the nation's destiny without public consent. The blueprint, once shielded by discretion, now found itself at the center of a widening storm. Debates erupted in legislative halls. Lawmakers questioned who had authorized such sweeping discussions and why they had been conducted in secret. Opponents framed the effort as a threat to democracy, arguing that financial power concentrated in elite hands could undermine the very principles the country claimed to uphold. Supporters countered that the public had suffered through too many crises and that bold, organized leadership was necessary to prevent further collapse. The argument intensified with each passing week, mirroring the fractures already growing within the syndicate itself. Inside the group, unease spread as the political world pressed closer. Some members urged a public rollout, hoping transparency might calm suspicions. Others insisted the plan was too fragile to survive open scrutiny. Mistrust seeped into their private exchanges, and what once felt like a unified mission began to resemble a battlefield of competing agendas. Every revision of the blueprint exposed deeper disagreements over authority, structure, and whose interests the new system should ultimately serve. Meanwhile, the broader economy amplified the pressure. Credit contracted in key regions, choking industries that had expanded too quickly. Small banks confronted waves of withdrawals they could not support. Railroads, already strained, struggled to secure the capital they needed to operate. Communities felt the tension daily, unsure whether their local institutions would survive another week. These tremors gave the syndicate's mission urgency, but also made the stakes unmistakable. Whichever path the country chose next would shape generations. Public frustration surged as stories of secret meetings spread through newspapers. Citizens demanded answers. Investors grew wary. Politicians capitalized on the controversy, using it to fuel campaigns, speeches, and accusations. The syndicate found itself cast not as architects of stability, but as hidden operators manipulating the levers of the economy. Some accusations were exaggerated. Others struck painfully close to truth. Regardless, the narrative took hold, placing the group under a harsh and relentless spotlight. Yet beneath the uproar lay a more subtle shift. Even critics acknowledged that the financial system could not continue as it was. The cycle of instability, speculation, and regional vulnerability had reached a breaking point. The panic of earlier decades still haunted the national memory, and every new tremor reminded Americans how exposed they truly were. The blueprint, flawed, contested, incomplete, was becoming a symbol of something larger, the inevitable confrontation between old structures and the demands of a modernizing nation. As divisions sharpened and pressure mounted, the syndicate approached its most precarious moment. The conflict was no longer about secrecy or influence alone. It was about whether a nation founded on independence could accept a coordinated financial framework, and whether those who designed it could hold their alliance together long enough to see it realized. The stage was set for a crisis that would test every assumption the syndicate had made, and force the country to face the consequences of its own unresolved contradictions. The reckoning arrived with a suddenness that left even the syndicate's strongest voices unsteady. A wave of public outrage surged after a leaked memorandum revealed far more coordination, than anyone had admitted. Headlines framed the group as puppeteers. Citizens saw a confirmation of their worst fears. And lawmakers who had hesitated now moved swiftly, determined to assert control before the blueprint advanced any further. What had begun as a private effort to stabilize a nation now stood accused of undermining it. Pressure mounted with breathtaking speed. Congressional committees launched inquiries. Governors demanded assurances that their states would not be sidelined. Newspapers published editorials declaring that no unelected circle should wield such influence. The syndicate's members, once confident in their ability to guide events, found themselves cornered by a public that no longer trusted intentions, only outcomes. Their unity, already strained, fractured under the heat of scrutiny. Attempts at damage control failed as quickly as they appeared. Some members argued for transparency and cooperation. Others feared exposure would destroy their reputations and weaken their institutions. The divide widened until a group could no longer act with single voice. Each leader retreated toward self-preservation, guarding assets, distancing himself from the controversy, and quietly dismantling the partnerships they had once embraced. The blueprint, ambitious, intricate, and incomplete, began to collapse under the weight of its own secrecy. As the dust settled, the nation confronted a sobering truth. The syndicate had not been entirely wrong in its diagnosis. The financial system was unstable. Regional inequalities were deepening. Crises were becoming more frequent, not less. But the method, the secrecy, the concentrated power, the quiet calculations behind closed doors had shattered public confidence. Reforms built on trust could not be constructed through silence. The failure underscored the one principle the nation had resisted but could no longer ignore. Real stability required transparency, cooperation, and a framework that belonged not to a privileged few, but to the country as a whole. In the years that followed, policymakers revisited the lessons exposed by the syndicate's unraveling. They studied its objectives, debated its ideas, and reshaped its boldest ambitions into proposals that fit a democratic system. The echoes of those clandestine meetings became building blocks for future reform. And though the syndicate itself faded from prominence, its influence endured, leaving behind a blueprint that would help guide the eventual rise of a new financial order, one forged not in secrecy, but in the open struggle to balance innovation with accountability. The story reminds us that even the most powerful vision can falter when trust is left out of the design, and that the future of any financial system depends not just on the structures we build, but on the people who believe in them, a currency at war with itself. It began as a quiet confusion that crept through markets and main streets alike. Two forms of money circulated side by side, each claiming legitimacy, each shaping daily life in different ways. And beneath that surface conflict lay a deeper battle over who truly held the power to define America's financial future. To understand why this struggle still resonates today, we need to return to an era marked by expansion, uncertainty, and competing visions of prosperity. The nation was growing faster than its monetary system could adapt. States issued their own banknotes. Private institutions printed bills of varying quality. And the federal government, still shaping its identity, struggled to impose a standard. The result was a landscape where money itself could not be trusted without scrutiny. This confusion created a strange dual world. In one pocket, a merchant might carry notes valued at full worth. In another, bills accepted only with hesitation. Travelers crossed state lines unsure whether their savings would retain value on the other side. Entire communities built their livelihoods on currencies that outsiders considered unreliable. Confidence became a regional language, spoken differently across every border. The tension grew more complex as states fought to defend their banking rights. Each institution believed its notes were vital to local commerce. But as trade expanded, inconsistencies caused friction. Some regions thrived, others stagnated. And with each disagreement over value, acceptance, or redemption, the divide deepened. Yet the early beats of this story reveal something even more significant. The currency conflict was not merely about money. It was about identity, sovereignty, and the struggle to create unity in a nation built on independence. Every dispute over notes hinted at the larger question looming ahead. Could America truly function as one economic body, or would its fragmented currencies pull it apart? These first fractures were only the beginning. The battle over control, trust, and financial coherence was about to intensify, forcing the country to reckon with the cost of a currency torn between competing visions.